Every month, without thinking twice, you pay it. Your car insurance, your health insurance, your life insurance. Maybe a home warranty on top of that. Maybe pet insurance because the vet told you it was worth it. You pay it because you're responsible, because you're protecting yourself, because that's what adults do in America. And every single month, the insurance industry thanks you for it, not because they're protecting you, but because you are almost certainly overpaying, by hundreds of dollars every single month, for coverage you don't fully understand, didn't properly shop for, and in some cases don't actually need. The average American household overpays on insurance by over $3,000 every single year. Not because they're careless, not because they're stupid, but because the insurance industry is deliberately confusing. $3,000 per year. That's $30,000 over 10 years. Invested at 10% annually. That $3,000 per year becomes $190,000 over 30 years. Not from bad investments, not from a market crash, from quietly overpaying for insurance you never audited. Today I'm going to show you the 4 biggest overpayment traps silently draining your household right now. And a 3-step audit you can run this weekend that could put thousands of dollars back in your pocket. Before we get into the specific traps, you need to understand the fundamental business model of the insurance industry. Insurance companies make money in 2 ways. First, they collect premiums. Every month, millions of Americans send them money. The insurance company pools this money together. They pay out claims from the pool. Whatever is left over is profit. Insurance companies are statistically certain that most people will never collect as much as they pay in. That is the mathematical foundation of the entire industry. If the average person collected more than they paid in, insurance companies would not exist. They are, by design, a system where the average participant loses money over time. Risk pooling serves a real purpose. Catastrophic events, a house fire, a serious car accident, a cancer diagnosis, can financially destroy a family. The legitimate purpose of insurance is to protect you from financial catastrophe. The problem is that the industry has expanded far beyond catastrophic protection. Today, Americans are sold insurance for appliances, cell phones, rental cars, gym equipment, pets, travel delays, identity theft, legal fees, funerals. Each individual product sounds reasonable. Collectively, they represent a systematic transfer of wealth from your household to the insurance industry, for risks so small and so manageable that you would almost always be better off self-insuring. A pricing system so deliberately opaque that most Americans have no idea whether they are getting a fair rate or being quietly overcharged by 40%. Let me break down the 4 most common insurance overpayment traps, the ones silently draining American households right now. Trap 1, the loyalty penalty. This is the biggest one, and almost nobody knows it exists. Insurance companies offer their best rates to new customers, aggressive discounts and promotions to win your business. But once you are on autopay, once switching feels like a hassle, they begin quietly raising your rates every single year. It is called price optimization. Insurers calculate exactly how much they can raise your premium before you will bother to leave. The longer you stay with the same insurance company, the more you overpay relative to a new customer with your exact profile. Loyal auto insurance customers can pay up to 40% more than new customers for identical coverage. 40% more for being loyal. The solution is painfully simple, and almost nobody does it. Shop your insurance every single year without exception. Trap 2, deductibles set too low. Walk into any insurance conversation, and the agent will steer you toward a lower deductible. A $500 deductible instead of a $1,500 deductible. It feels safer. It feels more protective. Dropping your deductible from $1,500 to $500 typically increases your annual premium by $300 to $500 per year. You are paying $400 more per year to avoid a $1,000 gap you will statistically use once every 7 to 10 years. Over 10 years, you pay $4,000 extra in premiums to avoid a single $1,000 deductible hit that may never even come. The financially correct move: carry the highest deductible your emergency fund can absorb and pocket the premium savings every month. Trap 3, coverage you were sold but don't need. The average American household spends $450 per year on extended warranties for electronics, appliances, and home systems. Extended warranties almost never pay off statistically. The failure rate of most appliances within the warranty window is extremely low. Whole life insurance sold to young, healthy Americans with no dependents. One of the most aggressively sold and financially inefficient products in the market. The difference in premium between whole life and term can easily run $2,000 to $4,000 per year for equivalent coverage amounts. Trap 4, autopay blindness. This is the most psychologically invisible trap of all four. The moment your insurance goes on autopay, your brain stops processing it as a spending decision. It becomes infrastructure like electricity or water. You stop questioning it, you stop shopping it. You stop noticing the annual rate increases, buried in the renewal notices you never open. The average American has not actively reviewed their insurance portfolio in over 3 years. Autopay is convenient. It is also the mechanism by which the insurance industry silently extracts its loyalty penalty, one automatic renewal at a time. I want you to meet Mike. Mike is 34 years old. He lives in suburban Atlanta, owns a home, drives a 5-year-old Toyota Camry. He earns $8,000 to $2,000 per year and considers himself reasonably financially responsible. He has never missed a payment in his life. He also has never once audited his insurance portfolio. Auto insurance, $2,100 per year. 6 years with the same company, never shopped alternatives, $500 deductible because it feels safer. Homeowners insurance, $2,400 per year, bundled with same auto carrier, never verified if the bundled rate is competitive. Life insurance, $180 per month, $2,160 per year for a whole life policy. Agent told him it would build cash value. Extended warranties and appliance protection, $380 per year across refrigerator, washer, dryer, and home security system. Total annual insurance spend, $7,040. Now let's run Mike's portfolio against what he should be paying. Auto insurance, shops 3 competing carriers. Identical coverage, $1,500 deductible. Rate of $1,340 per year. Annual saving, $760. Homeowners insurance, 3 alternatives reveal $1,850 per year with better claim service ratings. Annual saving, $550. Life insurance, fee-only advisor confirms $750,000 coverage needed. 20-year term policy at $38 per month. $456 versus $2,160. Annual saving, $1,704. Extended warranties, canceled entirely. $380 per year into a dedicated appliance replacement fund instead. Total optimized annual spend, $3,646. Mike's previous annual spend, $7,040. Annual saving, $3,394. Mike spent one Saturday afternoon making phone calls and running online quotes. That Saturday afternoon is now worth $3,394 per year, every single year going forward. Invested at 10% annually over 25 years, Mike's $3,394 per year becomes $371,000. One Saturday, $371,000. So how do you run your own audit? Here are 3 steps you can execute this weekend. Step 1, pull every insurance payment from your last 12 months. Open your bank statements and credit card records. Write down every single insurance-related charge. Auto, home, life, health supplements, warranties, subscriptions with insurance components. Most people are genuinely surprised by the total when they see it in one place. That number is your starting point. Step 2, shop every policy against at least 3 competitors. Use comparison platforms to get at minimum 3 competing quotes with identical coverage terms. Do not accept your renewal rate as a given. Call your current carrier and tell them you have received competing quotes. In many cases, they will immediately offer a retention discount they never proactively offered you. For life insurance, if you are currently holding a whole life policy, consult a fee-only financial advisor. One who charges a flat fee and earns 0 commission before making any changes. The math often strongly favors switching to term, but specifics depend on your age, health, and family situation. Step 3, Raise every deductible to the maximum your emergency fund can absorb. If you have 3 to 6 months of expenses saved, you can comfortably carry a $1,500 to $2,500 deductible. The premium savings are immediate and recurring. The deductible risk is manageable and infrequent. This single change alone saves the average household $400 to $800 per year. 3 steps, 1 weekend, potentially thousands of dollars recovered permanently. Here is the truth about insurance that the industry spends billions of dollars to prevent you from understanding. Insurance is not inherently a bad product. Catastrophic coverage, protecting your family from events that would financially destroy you, is genuinely valuable and worth paying for. But the industry has expanded that legitimate core into a vast ecosystem of unnecessary products. Deliberately opaque pricing and systematic loyalty penalties, all engineered to extract maximum revenue. The average American household will spend over $200,000 on insurance premiums over their working lifetime. Most will never audit a single policy. Most will never shop a renewal. Most will never calculate what that money, redirected into investments, could have become. You now know what most people never figure out. The question is what you do with it. Run the audit, make the calls, raise the deductibles, and take back the $3,000 per year that has been quietly leaving your household, one automatic renewal at a time. If this video changed how you think about what you're paying, share it with someone who hasn't audited their insurance in the last 12 months. They need to see this before their next renewal date. Subscribe to MoneyNoteLab and turn on notifications. Every week, we expose the financial systems quietly working against you and show you exactly how to fight back. We'll see you in the next one.